The world economy in 2023 is going to be a roller coaster ride for sure. The pillars of affluence that underpinned 30 years of economic expansion have given way. Inflation, labor shortages, and geopolitical turmoil are now challenges that the world needs to overcome. The global economy can crash in 2023? What we can expect about the coming months. So make sure you watch this video until the end to find more information. This decade has been given the nickname, the Paralyzed Decade, and not without reason. Already, a global epidemic, Russia's invasion of Ukraine, and inflation's return have rocked the foundation of the global economy in the 21st century. After the shocks of 2022, it seems like a safe bet that large parts of the world will experience a recession in 2023. It is more difficult to estimate, and it is more frightening, the long-term impact of the revaluation of money itself, as well as the overturning of the assumptions that have formed the basis of more than 30 years of global economic history. In the decades after 1990, plentiful low-cost labor, low energy and transportation costs, and a generally peaceful era in terms of geopolitics all helped to turbocharge the globalization of supply chains and drive economic growth around the world. Cheap money was always available to keep the party going, especially in the years following the financial crisis of 2008. This was especially true in the years after the crisis of 2008. Since 2001, the United States Federal Reserve, the European Central Bank, and the Bank of Japan have all maintained key interest rates that are lower than 5%. For the majority of the last 10 years, interest rates have hovered around zero and have been noticeably lower than the rate of inflation. In a period of time that is less than 3 years, each of these pillars that supported globalization has been destroyed. The United States, Europe, and the United Kingdom are experiencing a worker shortage, which is driving up labor costs. Since 2020, oil prices have increased by more than 3 times what they were, and in 2022 alone, the cost of energy increased by an astounding 50%. The Russian invasion of Ukraine has brought war to Europe, and both President Vladimir Putin of Russia and President Xi Jinping of China are openly challenging the order that emerged after the Cold War as well as the liberal values of the West. In retaliation, the major powers have declared war on the economy of Russia, and the United States has started openly pursuing policies that are designed to slow down China's rise. When U.S. Secretary of Commerce Gina Raimondo mentioned the possibility of denying advanced technology to China during an interview in October 2021, some listeners found it to be quite startling. U.S. export controls on advanced semiconductor technology aimed at China are now a reality. The Netherlands and Japan are being urged to follow suit, and the number of Chinese entities that are placed on a blacklist is continually growing. Global companies are left wondering whether or not the intricate supply chains that they have spent decades building will need to be remade, and if so, how. The most unsettling effect that all of these shocks had was that inflation picked back up again. In 2017, central banks around the world unleashed the most rapid and synchronized tightening of monetary policy in 2 generations. These central banks had previously ignored the first embers of the fire and instead rushed headlong into firefighting operations. During the spring and summer of 2022, more than 90 central banks increased their interest rates, with at least 50% of those increases coming in a single lump sum of 0.75 of a percentage point. This had a similarly dramatic impact on the prices that businesses, consumers, and governments paid for their long-term borrowing. At the beginning of 2022, the yield on the benchmark U.S. government bond of 10 years was approximately 1.5%, and the market anticipated that the federal fund rates would remain below 1% throughout the year. Instead, it finished the year above 4%, and analysts anticipate that 10-year yields will remain not too far below that level throughout the entirety of 2023. Not only the magnitude of the shift, but also its speed has never been seen before in human history. After more than 2 decades during which households, businesses, and investors got used to the idea that interest rates could always go lower, the rate on a 5-year fixed-rate mortgage in the United Kingdom tripled, from 2% to 6%, in barely 2 months. This occurred after the rate had remained relatively stable for more than 2 decades. The question of how the recent increase in the cost of borrowing will influence business investment, consumer spending, and government budgets will be an important one to consider in 2023. The second significant factor to consider is how businesses will respond to a world in which the current flow of history appears to be working against them. We are aware that home prices are falling as a result of the property being repriced in many countries to reflect higher mortgage costs. This is having an adverse effect on home prices. According to Bloomberg Economics, the current level of home prices in the UK is approximately 20% above what would be expected based on fundamentals. The percentage for the United States is 10%. In many different countries, the adjustment process has already begun. It is possible that Hong Kong will no longer have the most expensive real estate market in the world. Is it possible for economies to continue to expand even if unemployment rates and interest rates are both rising at the same time, that real incomes and housing prices are falling? It is about to become clear to us. In the United States, there have been instances of soft landings. However, those entailed slowing the economy down to a growth rate that was more sustainable, not slamming on the brakes hard enough to drive up the unemployment rate. Even a smooth landing in the US can drag other areas of the world down with a bump, as seen by the financial crises in Mexico and Asian emerging market economies, when the US started rising interest rates in the mid-1990s. The economies of Europe and the UK have already entered a recession. Bloomberg Economics projects a global expansion of 2.4% in 2023. That's the lowest annual rate since 1993, if you exclude the crisis years of 2009 and 2020. To sum up, easy money is no longer available, macroeconomic policymakers are being put to the test, and the fundamental geopolitical assumptions that have supported the past 3 decades of global economic integration are being placed into question. These tendencies could become even more severe if there has been a fundamental change in the historical link between economic activity and inflation in industrialized economies. As governments try to figure out what's going on and consumers begin to anticipate inflation's persistence, it's likely that interest rates will rise and remain elevated for some time. Recessions would be longer and more difficult to recover from for economies. In such a situation, politicians would be more prone to resort to unilateral, short-term remedies. The future looks bleak. Nevertheless, the following 12 months may see the globe being reshaped once again, in the same way that it was in 2022 due to unanticipated circumstances. It is possible that the United States may barely avoid entering a recession or will only see a minor reduction in output due to its robust labor market and still stable consumer balance sheets. It's possible that Europe's winter will continue to be on the moderate side, giving it plenty of time to get to summer. There is a chance that relief will soon arrive for households that have been struggling through the most severe decline in living standards seen since the 1970s. Emerging market economies as a whole have a chance of bucking historical trends and avoiding significant capital outflows, as well as a succession of financial crises. Ziad Daoud, the chief emerging market economist at Bloomberg Economics, believes that the risk of widespread defaults as a result of higher global borrowing costs is significantly lower now than it was in the 1980s. Additionally, the most vulnerable countries account for a much smaller share of the global economy. China represents the single most crucial variable in this potentially more favorable alternative future at this moment. The sudden abandonment of the COVID-0 measures in the closing weeks of 2022 stunned observers both inside and outside the country and caused an increase in the number of new infections. Nobody can predict how this situation will develop. Given how much personal investment Xi had already made in preventing the virus from spreading throughout the people, the chaotic reversal might have unforeseeable repercussions for policy. Once the incidence of infections has stabilized, however, it may prove to be a boon to economic growth in the second part of the year. That could, in turn, push up the price of energy, making it more difficult to keep a lid on inflation in both the United States and Europe. Bloomberg Economics predicts that a more rapid reopening may boost China's GDP growth to 5.1%, in 2023 and add approximately 1 percentage point to global inflation in comparison to a repeat of the 3% expansion China managed in 2022. An optimistic projection of global economic expansion of 6.3% could result in an increase in inflation of up to 1.7 percentage points. Could an uptick in global growth also come as a pleasant surprise? It appears that hopes for a general productivity dividend from COVID-19 as a result of higher adoption of automation and remote work are more wishful thinking at this point. However, the short-term pressures on supply chains are far lower than they were 1 year ago. In spite of all the discussion about deglobalization, the factors that a few years ago appeared to be on track to revolutionize the global economy have not disappeared. These factors include, for example, the digitalization of global services, the shift to a net-zero economy, and the increase of automation. Even while politicians in the United States and China are steadfastly moving in the other direction, these tendencies, when examined more closely, nevertheless, for the most part, move toward more integrated markets. The story of the microeconomy in 2023 will be how businesses attempt to square this circle by nearshoring and diversifying their suppliers in order to protect themselves against disruptions in the supply chain, as well as lobbying the government and resisting, to the extent that they are able, efforts on the part of the government to create splits between trading partners. In spite of the tough posturing, a large number of firms and investors appear to be betting that globalization, in some form, is here to stay and that the short-term consequences of a true unraveling will be too high for politicians to withstand. Given the icy winds that are sweeping through geopolitics, it's possible that this hope is likewise groundless. However, if central banks are successful in bringing inflation under control in the next year, practically everything is feasible and virtually everything will be simpler. Let's talk about the stock market in 2023. Since the stock market reacts to a wide range of variables, including economic conditions, government policies, and global events, speculating on its behavior in 2023 is fraught with uncertainty. However, some experts predict the stock market will keep rising thanks to low interest rates, a strengthening global economy, and rising investor confidence. A slump in the market is likely, but it's vital to remember that stock values are highly volatile and can be impacted by unforeseen occurrences. If you want to make smart investment choices, you need to perform your own homework and talk to a financial professional. This is the end of the video. Do not forget to like the video, subscribe, and comment down what you think about this video.